Hey everyone, welcome. Thanks for joining us this afternoon. I'm Rob Simone. I'm the REIT sector head here at Hedgeye, and today, as before, I'll be kind of wearing my other hat. And we have a really fascinating and fun guest today. His name is Greg Foss. So for those who follow Bitcoin closely, like Foss will be a well-known name. For those of you who don't know Foss, I thought it was a great fit for Hedgeye. Given that Greg, unlike many of the players in the industry, Greg sat in a risk chair, and he understands the value of risk management, but also has a really interesting framework for Bitcoin, and is also Canadian, so he shares our roots. Greg and I met in Miami. He was gracious enough to come on. So, Greg, thanks a lot for joining us. Much appreciated.
That's my pleasure. Thanks so much for having me.
Yeah, definitely. So maybe just talk to folks about your background, like how you wound up where you were, what your history is, and maybe how you found Bitcoin.
Sure. Yeah. Quickly. I'm Canadian. I grew up in Montreal. I went to McGill University undergrad, and I studied engineering. But to be honest, I was at McGill to learn, or not learn. I did learn, but to play sports. And 4 years quickly went by, and I realized I didn't really want to become an engineer per se, a professional engineer. And I was lucky enough to apply to one U.S. business school, and that was Cornell University, as you guys know, a great Ivy League institution in upstate New York. As an aside, Joe Nieuwendyk was the captain of the hockey team, all you Hedgeye hockey players out there. But 1986, I went to Cornell, and it was a great experience. I got to say, I was very lucky to get in. I would not have gotten in as an American. Not that my marks weren't good enough, but I just didn't have the work experience. But Cornell was trying to start an international business program. And when Foss got lucky and got into Cornell, and it was a great experience. I got to live the culture difference experience. Still to this day, very tight with a group of Cornellians, and I really loved the experience. And I had a chance to work on Wall Street, but I decided I want to come back to Canada, and I returned to Canada in 1988 after 2 years. And I like to term myself, I was a financial engineer. And my first job was working for Canada's largest financial institution, which still is, and at the time, was Royal Bank of Canada. So I was working in a special projects group directly for the CFO. And one of my first projects was working on the Latin American debt portfolio. Now, if you guys remember, some of you are too young for this, but 30 odd years ago, the global banking system had a huge problem with Latin American debt exposure, to the extent that U.S. Treasury Secretary Nicholas Brady in 1988 proposed a plan starting with Mexico where they would convert the defaulted loans of Mexico into a different structure. And not to get too granular, but the structure was a brilliant accounting gimmick to avoid the banks from having to write down the value of their defaulted loans to the market trading price, which was approximately 25 cents on the dollar. So they had lost 75 cents on the dollar of their 5-year loans. Now, I did a quick calculation before going into the Brady bonds of the Royal Bank's total exposure to Latin American debt and lesser developed country debt. And a back of the napkin analysis, Rob, that anybody could have done quickly showed me that the Royal Bank of Canada was insolvent, which, for those out there, just to be clear, it meant that their book value of equity would have been vaporized if you had written down all the value of their lesser developed country debt to the market trading price. Hence, Treasury Secretary Nicholas Brady said, whoa, we have a big problem, because it's not just Royal Bank of Canada, it's the entire global banking system was insolvent. Now, here's the kicker. I'm only 20-something years old. I'm coming right out of school. I go to the CFO, and I said, his name was Emil, we have a problem. And he looks at me, deadpanned, and goes, I know, don't tell anybody. And I'm like, what the absolute F? Like, I just got out of school, and I'm working in this thing called a fiat Ponzi. Now, fast forward 30 years. You mentioned you got involved in Bitcoin in 2013.
Mm-hmm.
I was introduced to Bitcoin in 2016, where I actually did some work on it. And I was like, oh my God, this is the solution to the fiat Ponzi that I had been worried about for 30 years and worked and made a pretty good living as a hedge fund manager through various financial crises, but never had the solution. And Bitcoin is that solution. And I'll just summarize it, and we're gonna get a little more granular on this. Sure. I love everything from a credit perspective. I'm a credit risk trader. I view Bitcoin as being the perfect insurance against the fiat Ponzi. And we can go into that, but most importantly, from a risk manager's perspective, Bitcoin is the best asymmetric trade opportunity and investment opportunity that I have ever seen in 35 years of managing risk, okay? So you got all these talking heads out there that think it's a Ponzi, blah, 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 because they haven't done any work. The real Ponzi is fiat. We see this again and again as the global financial system is regularly insolvent and it is bailed out by central bank printing. Bitcoin is the best asymmetric investment opportunity I have ever seen in 35 years of managing risk. And that's why I'm passionate to spread that view to people and their children who need to understand this.
Sure. Yeah, no, that's great. And maybe two things we can dig into there. And I think, but correct me if I'm wrong, in thinking about like fiat as a Ponzi, it really gets into the difference between nominal and real returns, or at least as I understand it, right? Because but I don't know if you have a different view or like how you think about the Ponzi-like dynamics of that. Maybe you could talk about
a little bit. Yeah, let's talk about banking to begin with. Okay, so a bank is, everyone thinks your bank is so safe, and to the extent they're not wrong as a depositor. But understand first and foremost how a bank works. Okay, a bank will make for $100 loan. It only holds about $6 of equity capital, and the other $94 is depositors' money and subordinate debt. Now, over the period of an economic cycle, I can promise you there are many times where the book value of equity of that loan will fall by, the value of that loan will fall by more than $6, which means the equity or the risk absorbing gets vaporized. Okay, that is the Ponzi itself. Because banking only works if you can lever it 20 times. Because no one will lend with zero leverage. The returns don't, on a risk-adjusted basis, unless you can use leverage in banking, the equity owners would never invest in bank stocks. Okay, you need to use leverage. So as Henry Ford said over 100 years ago, if the average American understood how the American banking system worked,
there'd be a revolution.
In the morning. And that's based on that fact. Okay, yes, a lot of depositors have tremendous confidence that most banks are too big to fail. Hence, they will be bailed out by the Fed or the central bank. Therein is the Ponzi. How do you create a system that has no natural risk mitigating or risk pause for investors? It's depositors get bailed out. Depositors should be the ones that are the detectives and saying, "Oh, I'm causing a bank run on a regular basis." So this is part of the inherent problem of the system, in my opinion, Rob.
Yeah, definitely. And actually, like the Henry Ford quote is great, and maybe we can get back to that because he had another really great quote that is pertinent, but in a minute. But in thinking about Bitcoin as an asymmetric trade, Hedgeye folks will probably have heard me say the same thing as well, and there are risk management implications around that. But when you think about it being asymmetric, like how do you define that? Like how do you kind of size your upside and just to give people a sense of like how it's skewed?
Yeah. So everything, first of all, I look at everything through a credit lens, as I've tried to lay out. But let's take this a step back and look at what the total global pie is, your total global addressable market, okay? And I start with a number of total global financial assets of over US dollar 900 trillion. Okay, that's your total global financial asset pie. And of that, 400 trillion is global debt, and 300 trillion is global real estate. Okay, and then 100-ish trillion is equities, and the balance is commodities and fine art and all sorts of other, when it comes right down to it, gold. Okay, gold's 10 trillion. Like, sure. Who cares? It's a bit of a rounding error.
Yep.
But 900 trillion is your total global financial assets. These are numbers from the Institute of International Finance. Okay, and a lot of people say, "Oh, why are you including debt?" Well, heck, I spent my whole life in the debt markets, okay? That's what you got to start with, okay? Don't net out debt. So you hear all these other guys using numbers like 400 trillion. God, these are equities. Anyway,
it's an enterprise value concept.
Thank you.
Yeah, right.
Buddy, you grow up in the credit markets, you learn enterprise value. You don't do market cap by, EBITDA, market cap to EBITDA makes no sense. Enterprise value to EBITDA makes a ton of sense. But anyway, okay, look, without getting too crazy, here's the thing. 900 trillion, I think, and we'll get into this, there is a high degree of likelihood that Bitcoin becomes the global financial asset, reserve asset of the world. It'll supplant U.S. treasuries, okay? If that, in fact, is the case, and I'll mention further why I think that'll be the case, it has a link to to oil and pricing of oil. But stick with me. 5%, I think, is not a crazy number for Bitcoin to capture of the total global financial assets. 5% of 900 trillion in today's dollars is $45 trillion today. Divide that by 21 million. What do you get? You get over $2 million US per Bitcoin in today's dollars. That is a target. It's not a limit. And I'm not giving you a time frame on when it gets there, but don't forget, I'm measuring it in today's dollars. Okay. That's your asymmetric target upside. It's currently trading at 20,000. Okay. What's 20,000 divided by 2 million? 1%.
Yeah, you're looking at 100.
The market is telling me right now, Foss, you may be a lunatic, but I'm only giving you a 1% chance that your price target is right. And I'm not telling you guys I'm 100% certain I'm right, but I am telling you I'm way more confident than 1%. So buy the stuff with your eyes closed as insurance against this fiat Ponzi unraveling. And go ahead.
No, I was going to say, and another like interesting way of saying that, and this may be right or may be wrong, I guess time and the markets will prove this out or disprove it. But another way of saying it is that the market is ascribing a 99% chance that it's a zero.
Bingo. If you use a binary outcome, it's either worth 2 million or zero. Yes, but what's the reality, Rob? It's a continuous distribution, and that's why you need to learn statistics, and you need to understand continuous probability distributions and actually calculus. But God forbid I'll bring calculus into the room. So
well, we're all about it. So
let's just talk about binary outcomes, okay? Binary outcomes, A or B, nothing in between. Okay, yes, you're making the exact assumption that, or the exact correct expected value calculation using a 99% outcome of a zero and a 1% outcome of $2 million Bitcoin. But what's the truth? Well, the tail on Bitcoin goes far further to the right than just $2 million. Now, the good thing is Bitcoin is bound at the lower end by zero. And what's the chance it goes to zero now? You can argue, well, it's not going to go to zero. Would it go to $100?
A lot lower.
Let's just understand that this math makes it the most compelling and simple argument as to why you need to do some mathematics to learn risk management. Again, I'm not 100% certain, nor do I tell you to put 100% of your money in Bitcoin. What I do tell you is get more than zero. And what is the right number? Well, this depends on every individual in the risk management share. My personal number is over 10%, but less than 40%. There's a lot of crazed Bitcoiners on Twitter that think that I'm some sort of little, weak little limp-backed guy because I don't have 100% of my money in. And I'm like, guys, I don't need to have 100% of my money in. The asymmetry of the trade will ensure that I will participate in the upside. That's the beauty of it. Yep. So you'll say, Foss, what other assets do you own? And I go, I own, oh my goodness, gold. I own real estate. What I don't own right now is any bonds, because bonds are actually the worst investment opportunity I've ever seen in the 35 years of managing risk. Treasury bonds, I covered my short. High yield bonds are still the most mispriced of the high yield bond history over the 30 years I've ever been trading it. The reality is the expected default rates are way too low.
Yep. And
nominal rates are way too low to actually properly reward you for the defaults that are coming.
Yep.
That's not even including inflation expectations, okay, Rob?
Right.
So this is such a bamboozled market because it's been artificially manipulated by the Fed when they went in 2020 and started buying high yield bonds. Mm-hmm. Can you imagine if you told me in 1988 that the Fed would ever buy high yield bonds? I spent my career in the high yield bond pits. I would have said, you're out of your mind.
Well, you would have told me it was illegal, for one. But, they find a way to do it.
You can change the rules or move the goalposts, right?
Yeah,
or move the goalposts.
Stick it in an ETF and buy the ETF.
Let's stick with that. Why did they have to enable the balance sheet to buy high yield bonds? It was basically because there is a situation that still exists in the U.S. market where you have four borrowers: Ford, General Motors, AT&T, and General Electric, that are right on the cusp of this subjective fallen angel cusp of investment grade down into junk or high yield.
Right.
The combined debt of those four borrowers is larger than the entire high yield market as it exists right now. And if they got downgraded, they would overwhelm the ability of the high yield market to absorb the forced selling of investment grade managers. Investment grade, another term that has no no quantitative value. It's a subjective value. What makes something investment grade? Oh, the rating agency says it's investment grade. How do you determine an investment without looking at its price? All of these things are part and parcel of the fallacy of this fiat Ponzi that is built on top of regulatory authority that leads me to say, if you own 0 Bitcoin, go and work for Peter Schiff, okay? Because he needs idiots to work for him.
Okay? Yeah, Peter Schiff's having a tough week. I don't want to pile on.
Why not? Listen, he's the knucklehead that didn't even understand that Puerto Rican banks have capital guidelines. Can you imagine that you're allowed to have a bank and you don't even understand? Anyway, I sort of like Shifty, but quite honestly, he makes me ill most of the time.
I know.
Because he tells outright lies. But sorry, I'll
No, it's unconscionable. It really is. And it's great that you said that. And so as you know, Hedgeye, we're a macro shop. We kind of go everywhere across all asset classes, and we're very rate of change focused. So right now, our current call is for what we call a quad 4. It's where both growth and inflation are decelerating. Not necessarily going negative on an absolute level, but the rate of change on the margin is really
the second derivative. Okay?
Exactly. Yeah.
You guys are physicists. You're second derivative guys. I get it. I love rate of change. Okay. Yeah. Here's the problem. You know that inflation compounds.
It does.
Everyone's like, okay, I'm excited. Inflation's going to drop from 8.6 to 6.8. Are you guys out of your minds? You actually think that's a good? Yeah. Disinflation does not equal deflation. That's you compound those two numbers. Yeah, the rate of change is decreasing. But when you start at a velocity or the first derivative that's out of control, your acceleration, even though you're still, you're still going forward, you're not going to get back to negative velocity very quickly, okay? If you actually aren't. That's the way math works, okay? So here's the problem. Most people have no idea when you talk first derivatives and second derivatives, rate of change, their eyes glaze over. They're like, oh, they told me there'd be no math. Well, if you thought there'd be no math, you shouldn't come to the financial markets because that's all financial markets are, especially bonds. Bonds are a mathematical contract. That's why I'm sort of comfortable in that chair. I do the math. I like the math. I play probabilities. Let's go forward.
Well, and just sticking on the math, I think, correct me if I'm wrong, but that's actually one of the reasons why, at least in my humble opinion, Bitcoin, and people will choose their own price, their own entry point, make their own decisions, but Bitcoin deserves an allocation because if you think about it, even with the 10-year between 2.5% and 3%, at a negative real yield, compare that with Bitcoin that's effectively a perpetual zero coupon bond in a way that appreciates or at least offsets fiat debasement.
Okay.
So like there's an interesting trade to be made there potentially where you effectively go short the negative real yield on a treasury or any name your bond.
Yeah.
And by the way, inflation's probably understated.
I agree.
Replace it to some degree with this asset that basically is an indefinite call on, or actually an indefinite put on fiat.
Put call parity. It doesn't matter. Put call parity.
Sure. Either way, right.
At the end of the day, it doesn't matter, right? Yes, you're totally right. I believe Bitcoin is the most perfect option ever created, and most importantly, in the options market, it has no theta, which means there's no time decay, and it has no counterparty risk. And if you don't understand what I just said about counterparty risk, keep your money in Celsius and all that other stuff, you knuckleheads, okay? God. Understand that having an option contract with a counterparty that defaults is what brought down the financial system in 2008. So I traded a lot of credit default insurance. And imagine if I had purchased, I didn't have this, but imagine if I had purchased default insurance on Bear Stearns from Lehman Brothers. And I needed that insurance because I had a contract out with Bear that they, in the event that something went wrong, I needed Bear to cover my my exposure. But I can't buy default insurance from Bear Stearns on Bear Stearns. That doesn't work. So I bought it potentially from Lehman Brothers. And then all of a sudden Lehman Brothers is cratering. Now I have to go out and buy insurance on Lehman Brothers, which was basically my insurance on Bear Stearns to begin with. Okay? And this is what happens in contagion in the credit markets. It's like a game of whack-a-mole. And we saw it now unraveling in the CeFi or DeFi space because some of these people didn't realize that, when I say some of these people, the shitcoiners out there said, oh my goodness, let's recreate the traditional financial system on these other CeFi platforms or whatever. What a mess. There's only one insurance policy in the world on the fiat Ponzi, and that's Bitcoin. All of this other stuff, take it and flush it, okay? It's worth not anything against the fiat Ponzi. You may say, oh, Ethereum and smart contracts, this. Okay, I get it. But what is the supply of Ethereum? No one knows.
No one knows.
Well, there you go. Yeah. So how do you actually calculate anything? Here's the crazy thing. There may be people who are listening to the, crypto allocators. There's Bitcoin and then there's other digital assets. And Bitcoin is the only digital asset that solves the fiat Ponzi. Mm-hmm. Well, that's why I love Bitcoin.
Yeah, I mean, just taking it back to what I do day to day, it would be like me trying to, trying to analyze a company, but not knowing its share count. So how do you do that, right? There's no way. Yeah, it's impossible. You can't do it.
It is impossible because people will say, well, what did you use for the denominator? And you'll go, well, I sort of took this average. Vitalik told me it was difficult. So how about he says it's difficult, and here's what I think it is. What a sham, okay?
Yeah.
Look, at the end of the day, mathematicians understand the value of certainty, okay? The only thing that is certain is that fiat currencies will continue to debase on an accelerated basis because the debt spiral that we have accumulated makes it absolutely required that printing of money solves the debt spiral, which is to say printing of money or the currency is the error term that allows the expansion of the debt balloon because our GDP will never keep pace with the natural or organic growth of the debt due to the coupon. That's what debt is, people. It's a fiat contract, and part of the contract is a coupon that needs to be paid. And guess what? If you don't pay that coupon, it's called a default. And in order for the USA not to default, what they will have to do is continue to print money to pay the interest coupon, because it's impossible that the GDP growth will keep pace with the growth of the coupon. Very simple math, hard for people to get their head around it. I suggest everyone goes out there and reads Luke Groman's analysis and lots of other smart people, Larry Lepard, you get it. Isn't it interesting that a lot of people that get it come from a credit share, okay? Because credit runs the world. And a lot of equity guys run around, they don't even understand where the bonds of the same company that they own the equity of, they don't even know where the bonds are trading. And yet they have a subordinate claim to the debtor or to the borrower. So, or the lender rather. They have a subordinate claim to the lender. So at the end of the day, though, if you don't know where the bonds are trading and you own the equity, you should fire yourself. Okay, just fire yourself because you haven't even looked at the entire capital stack. But that is a frequent occurrence on Wall Street.
Greg, I can't remember if it was globally or if you did it for Canada or the US, but you, and at least in my opinion in the past, I've seen you very eloquently lay out that math in a very straightforward way on how the currency becomes the. Would you mind doing that?
Sure,
I think it's an interesting framework, and a lot of people don't think that way.
Thank you. No, it's okay. So it's important. Okay, so look, total global debt to global GDP is 4 to 1, which means your debt is 4 times as large as your revenue or your ability to create tax, okay? So when your numerator, which is your total global debt, is 4 times your denominator, and your numerator is growing on a contractual basis, because that's what debt is, let's throw a number on the coupon, the average coupon in the numerator. And I'm going to use 3%.
3%, sure.
Because US 10 years, 3%, but this includes shorter term debt. This includes all corporate debt, all municipal debt, all state debt, all junk debt, all structured product. 3% is actually a really low number. Okay? Because junk yields right now are 8.8 and change. So, the weighted average of the numerator, 3%, which means the numerator is growing at 4 times 3% or 12% annualized relative to the denominator. Is global GDP going to grow at 12% to keep pace with the numerator?
Not on a real basis.
Absolutely not. Now, here's the crazy thing then. It means that the debt balloon is expanding faster than the tax base can possibly expand, which means you need to fill that void using an error term, which is printing of money. Got it. 100% certain.
Yep.
100% certain.
Yep. Yeah. No, it's just a really valuable framework.
Thank you.
To simple, because it's complicated but simple at the same time, right? There's so many different layers to it underneath the surface, but using round numbers like that, it illuminates the problem that Bitcoin solves for, or at least tries to solve for.
Well, Bitcoin doesn't solve it. It's your insurance. Because, fiat, Bitcoin will exist in a parallel system for a long time where fiat still exists.
Yep.
But you need to understand that fiat is programmed to debase. It's how it exists. It is programmed that way. Whereas Bitcoin is programmed the opposite way. Bitcoin is programmed for scarcity. Yep. Whereas fiat is programmed to continually add, to keep pace with the debt balloon, because we passed the point of no return. It's basically the escape velocity. We can no longer achieve escape velocity from the debt spiral. Very simple. Okay,
so actually, you hit on something before. Maybe before we go to the energy angle, I detected in your comment earlier a distinguishing, and I think this is something that people who don't, or actually Bitcoiners as well, but crypto Bitcoiners, people that just follow the markets, that drawing a distinction between the reserve currency and the reserve asset.
Oh yeah.
But maybe can you talk about that? Because I think that's an important distinction that's very nuanced, and people don't think about it a lot.
Bingo, and it's going to lead us into the reserve asset versus, excuse me, or the energy angle.
Right.
Okay, so look, a reserve currency. The USA is the global reserve currency. Part of the reason is because of a petrodollar system. There's your energy angle coming right now. But reserve currency, you can think of a reserve currency as the fiat that prices global commodities, US dollar. Also, it is basically the link to the reserve asset right now, which is US Treasuries. Okay, when a energy producing nation, let's walk through the energy angle, like Saudi Arabia sells oil to the rest of the world and it's priced in US dollars, they get US dollar currency inflows, and they take that US dollars and they likely buy US Treasuries with it and hold US Treasuries on their central bank balance sheet, okay, or in their treasury reserves. Okay, so the important thing to remember is globally, US Treasuries, while it currently still is the US Treasury reserve, the global reserve asset, it is falling. So on central bank balance sheets, US Treasuries used to account for 71% of reserve assets, and now they account for 59%. That 12% reduction in US Treasury holdings, and these are countries like Japan, China, and Russia, that 12% reduction in Treasury holdings is a very bad thing for a global debtor nation like the USA, because you can't run out of lenders. You need to have people that are willing to roll your debt, not mature your debt, roll it, because in a debt spiral, debt doesn't mature. It just gets rolled over, right, Rob? So who fills the blank when, global central banks aren't buying US Treasuries as a US asset? Yes, the Fed does, correct. But let's talk about what a reserve asset is. Right now it is US Treasuries, but it can also be other things like European central bonds. It can be gold. It can be all the other things that a Federal Reserve Bank or a reserve bank, central bank, holds on their balance sheet. Canada, just as a side note, sold all the gold that we ever owned in our central bank. Great move? I don't think so, but I never accused the Central Bank of Canada, the Bank of Canada, of being very smart. But as an aside, let's move it into the energy angle. I believe that, as we mentioned before, there will be a time when global energy producing nations decide that they'd rather get paid in Bitcoin, which is digital energy, rather than US dollar fiats. So does it make sense? And particularly from an engineering perspective, for Foss it does, because I grew up with this law called the first law of thermodynamics, which is the rule of conservation of energy. Okay, if you have valuable natural resource energy and you're selling it for debasing US dollar fiat, that's not a great trade, okay? From an energy perspective, it's a horrible trade. You are taking energy, which is a store of value in the ground, and you are selling it for paper money that is guaranteed to debase. Well, what if some people said, I'd rather sell it for Bitcoin? If you sell it for Bitcoin, you are trading natural resource energy for digital energy. That's my engineering side. But this is where Bitcoin can become a reserve asset. It doesn't have to be the reserve currency. The reserve currency can be like a checking account. And that's what currencies are good for. It eliminates barter. I have a cow and I want 3 chickens. Well, how many chickens go into a cow? I don't know, but it's easier to do it with money, okay? Or with a currency that eliminates the need for a barter. And so, point being, think of your currency as your checking account. The reserve currency of the world will still likely be the US dollar in some way, shape, or form for the foreseeable future. Your checking account, though, has to be markedly different from your savings account. And your savings account should be Bitcoin.
Yeah.
Because fiat dollars are a horrible savings mechanism because you get it stolen or debased away from you. So that's the difference between a reserve asset and a global reserve asset and a global reserve currency. Yeah. Okay. Fiat currencies exist so that we don't have to trade, sand for eggs. And, I could just go on and on. The point is, What you want is you want to have a checking account and a savings account, and your global reserve savings account, I believe, will move from US Treasuries to Bitcoin as the energy angle plays out. And look no further than Mr. Putin, who just, not that I agree with anything he's done, but that being said, when he thought he had US Treasuries as a reserve asset that got frozen on him, that's not much of a reserve asset.
Well, it's a default.
I mean, he basically didn't have access to his savings.
Yeah.
Like, think this through, people. And
it's a default. It's a default. Like,
correct.
Yeah.
Correct. And here's the craziest thing. He sold his valuable natural resources for US dollars, which he converted into US Treasuries. Mm-hmm. I mean, it doesn't take a rocket scientist to think that, well, there's probably a better way and someone's going to do it.
Yeah.
And I would love if it was Canada that was doing it. But, Canada and the US are too tight from a military spirit. Well, we don't add much to the military equation, but we are a great trading partner. There would be political pressure not to price Canadian oil and natural gas in Bitcoin. But let me tell you, for my kids, I want it to be priced in Bitcoin. As much as I love the USA, and I told you I went to school there, and the land of freedom and everything, I don't love US dollars that much. Every single fiat is a melting ice cube. It just happens to be that the US dollar is melting at a lower rate of decay than any other fiat out there, particularly right now.
Yeah, and this actually gets back to the Henry Ford, the other Henry Ford quote, right? So
correct.
He said very famously, what we should do is create an energy-backed currency, which will eliminate all wars. Now, irrespective of the war argument, I think this is something that's really important about, regardless of whether or not you want to participate in Bitcoin, like understanding its connection to energy. There is a cost of production to produce Bitcoin that is denominated in units of energy. And so there is this connection directly between the production of Bitcoin and the consumption of energy, whereas in a fiat world, you're creating new fiat out of thin air to buy energy.
Isn't that crazy? That's what's so valuable for the United States, though. Essentially, the USA is able to print energy.
Yeah.
Wow.
Yeah. Right.
I mean,
exactly.
If that's not a strategic, benefit, and a world-class, starting point, I don't know what is. But Canada, we have a lot of energy, but we can't print it. Okay, we have a fixed supply of it. Whereas the United States, they can print it.
Yeah.
Now, you could argue they could print so much that they can't own all the energy in the world, but let's stop looking at extremes. Focus on the donut, not on the whole. Okay. Yep. The donut is that Bitcoin is a currency that has, and a store of value that has lots of engineering applications. And as you mentioned very nicely, it is based on the principle of conservation of energy. It has an energy component in it.
Yep. Okay, so we've been. By the way, Greg, this is awesome. I feel like we could talk for hours, and
I bet we could. Yeah, we could.
It was really great talking over beers and in Miami.
I agree. That was fun. Yeah, that was really fun.
It was a lot of fun. But I want to just for the next couple of minutes. There, we have some questions from the Hedgeye audience. Want to open it up. So I have a couple in the queue. Some are anonymous, some are not. But Greg, so this is actually an anonymous question. But Greg, in your opinion, when will BTC start to decouple from legacy markets, or will it continue to function as a pure commodity and essentially trade with a commodity basket? What's your view on that?
Yeah, I think it's a great question, and I hate to answer it this way, but I have no clue. Mm-hmm. If I knew that, then I wouldn't be going
here
out telling people. I wouldn't be here. But here's the truth, right? Then there's a famous quote in trading too: "Give a target, never a time," or "Give a direction, but never a target." Okay, so don't. I have a price target on Bitcoin that requires it, or is one of the components of it, is that it will decouple from the current algo-driven trade in New York, where they treat Bitcoin as a risk asset. I believe Bitcoin is credit insurance, as I've mentioned before. And when you are short credit, which is the equivalent of owning insurance, you are long volatility. Okay, that's a absolute credit viewpoint and a truism in credit risk management. So I view Bitcoin actually as being what's called a long volatility product, which means it should actually increase when vol increases, vol being a measure of risk. Right now it isn't. It's correlated with vol, or inversely correlated with vol, when I think it should be correlated with vol. So as the VIX goes up, stock prices go down, and Bitcoin has gone down. When does it break? It'll break, I believe, very quickly. I can't give you the time, but when it does, it'll be like a dam bursting because people will realize, oh yeah, it is the insurance that I've been looking for. And what will it take? Well, it'll take some big ass funds like Fidelity that's already there, or one of the other top 5 global asset managers that just not only writes a paper to say this, but actually divulges a position that's like going to open some eyes and says, yeah, so we own 5% of our assets in Bitcoin. And the reason we own it is because the other 95% of our assets are short volatility assets, which is like equities. It's a short volatility asset. And we wanted long volatility assets to hedge against it.
Yeah.
Boom.
Makes sense.
It ends. I can't tell you when, but I know there's enough smart rocket scientists that actually should be working in rocket science, but work on Wall Street, but are too stupid to look outside the box in the short term. They got to figure this out themselves. That's why I wrote the paper that you very, nicely mentioned that you had read. I wrote it for credit portfolio managers. Why? Well, because credit is the largest part of the global financial assets. Once they get it, though, to answer that person's question, it'll be like a dam exploding. And I'm confident it'll happen. When, though, I cannot tell you.
Yeah. Well, on that paper, by the way, when we post this on YouTube, I'll make sure to link it in the notes so people can read it themselves. It's definitely interesting.
Thank you.
Yeah,
Thank you.
Definitely. So this one's kind of interesting and it's topical. It's from Nimish Patel. Greg, you being a credit guy, any thoughts on? I'm sure you have thoughts on this on stable coins and leverage, Tether. It's collateral backing, et cetera. Like what are your so it's obviously very important.
Okay, so let's start. Great question. Okay, so let's start with algorithmic stablecoins. What a disaster. Okay, if you had looked at that thing for 2 seconds, you would have realized that it was basically the fiat system and the fiat Ponzi in digital. Okay, so I wish I had done more work on it just to warn people about what a actual Ponzi it was. And hindsight's always 20/20, but unfortunately, some large Wall Street perceived smart money managers got behind it. Some of them may have gotten tattoos. I'm not pointing a finger at anyone, but Novogratz, that was dumb. Okay, so algorithmic stablecoins, I will never buy that. Stablecoins themselves and Tether in particular, there's the difference between a stablecoin that is backed by assets that can have a component of default risk versus other assets that have very, very low default risk components, or in fact 100% the thing you're trying to represent. So everything, the proof will be in the pudding. And I think there was a cryptic question regarding Tether. So the truth is that the disclosure by Tether is somewhat much like a commercial bank. They sort of have 5 lines of disclosure and they lump everything in there. So they'll say, this commercial paper to AAA rated risk is X percent, much like a bank will say, I got commercial and industrial loans, I got mortgages. Bang, there's just so much you throw in one line item of a disclosure of a commercial or of a financial institution. Tether's no different. So let's just play some math here, though. Tether is what, 60 some odd $billion still? Yeah. And imagine they do have 10% of exposure to Evergrande. Just imagine, all right? So that means that they own 10% of the outstanding commercial paper of Evergrande that's a bagel. Okay, so that $66 billion has gone down, or $60 billion has gone down to $55 billion. It doesn't mean that it goes to zero. It's not a Luna, okay? I need you guys to understand the difference between something that is backed by assets versus something that's backed by a computer program that was based on faulty math. And just because the guy went to Stanford didn't mean he could, recreate the fiat Ponzi and not fall into the same run on the banks that happens in the fiat Ponzi and is only solved by a Federal Reserve that steps in and stops the bank runs. Okay.
Well, the peg mechanism. The peg mechanism was lunacy, right? Like, I mean, no pun intended, but
yeah.
I mean, it's great. Like, it's one thing to maintain a peg based upon like actual, fiat, like I guess dollar assets or whatever currency you want to use, but to maintain a peg algorithmically based upon another crypto asset.
It was the fiat Ponzi because the Luna token was the debt and Terra was the currency.
Yep.
And if you want to understand what happens when you keep printing debt to support the currency, you need a central bank behind you that can stop a run on the global financial system.
Right.
Sorry, but Luna wasn't that big. And despite Do Kwon and his trust in mathematics, he started with a bum program, okay, in my opinion. Garbage in equals garbage out, right? That is what a bad computer program is. Garbage in equals garbage out. It was backed by some large Wall Street players, including some of my friends that lost some money. When I say my friends, digital asset managers. Even though I'm a Bitcoiner through and through, and I don't find value in many other, if any other digital assets, I don't like to see people lose money.
Of course.
Now, if you lose money and you've done it as a proper risk management, but proper risk management is not doubling down on a losing position, okay? And there are people out there that lost money and then they lost more money because they doubled down on a losing position. And that is not how you manage risk, people. You manage risk by getting rid of your losers, not doubling down on your losers.
Yep. Okay, so one more from the audience, and then I want to close out with one, I think, like really important question that doesn't get asked enough in the Bitcoin community, in my opinion. But Greg, so this is from Sean. Greg, do you trade in BTC or do you just hodl? Also, do you engage in DCA? Thanks for this excellent conversation and your work, both of you.
Okay, so, I'm not a liar. Of course I traded. Come on, guys. Look, I've spent 30 years as a trader, okay?
No,
like, are you going to tell me,
yeah.
I manage risk by, selling, taking risk off the table when it's made a good pass so I can buy some more at a price that may not be as high as where I've sold it. I will never own zero Bitcoin. Mm-hmm. But listen, there was a time when I owned over 50% of my net worth in Bitcoin. Mm-hmm. And that's a big number.
That's big.
And for me, any risk manager that has 50% of their assets in one silo probably needs to adjust that silo. Now, if you're a crazed Bitcoiner that has 100% of your money in Bitcoin, I would suggest perhaps that, perhaps your net worth or your accumulated net worth as a 25-year-old may not be the same as your accumulated net worth of an old fat white guy like me, okay? So I just manage my risk a little differently than a 25-year-old kid, and I should. A young 25-year-old kid can afford to have a higher percentage of his or her net worth in Bitcoin. I have 3 kids. I have a house, more than one real estate property. I own equities. I don't own bonds. That being said, I manage risk by always switching between those. I don't need to own 100% Bitcoin. So, do I trade Bitcoin? Yes, I do. Sure. Am I currently buying Bitcoin? Yes, I am. Did I take sales at higher prices? Yes, I did. Mm-hmm. That being said, don't overthink this. Bitcoin is stupid cheap, even if it was over $100,000. Mm-hmm. It would still be stupid cheap. So, yes, I trade it. I've made a career in trading. The only thing I bring to the table, Rob, is 35 years of mistakes, okay?
Yeah, sure.
The only thing I learned is how I'll do it differently next time, because I made mistakes either getting too greedy, holding all my stuff in one silo, rather than spreading out the risk, keeping some powder dry. Do I advocate DCAing to get up to your portfolio allocation? Yes, I do. I think Bitcoin's very cheap. Is it impossible that it goes down by another 50% from here? Not at all. But it would still be stupid cheap at twice the price. So buy some now, allocate how much you need to own over the next 26 weeks or half a year, divide your allocation or your investment into 26 parts, buy a little bit each week. When you get to your portfolio allocation, if the price doubles or triples, yes, you are allowed to take some off the table. Okay, you are allowed to, because that's what proper risk managers do. Do I advocate following all these trading advice and guys that have YouTube channels? Come on, guys. Nobody knows anything about where the price of Bitcoin will be within 2 weeks. What I do know within my lifetime is that I'm highly confident it'll be far higher than where it currently is. How it gets there, I don't know. And
Sure.
if you asked me if I did know and I told you I knew, I'd be a liar. So I try not to lie.
Yeah, definitely. And one other, so maybe one other angle about on that. I'm personally I've been very vocal about this. Another option is if you decide to own the spot, there are paper options out there to trade to hedge your risk, right? So that's on the table too. So one thing that I do. We use we have a trend tracker that we publish for Hedgeye, and we'll go bearish or bullish crypto broadly and Bitcoin specifically, but also the paper vehicles, depending on what quad and what the signal's saying, what quad we're in the economy, and what the signal's saying. It's perfectly fine to own the spot and hedge out your position with the paper vehicles.
Okay,
right?
when you're a vol trader, which I was, okay. When you're a credit trader, you're actually a volatility trader, okay. And when you can buy and sell vol at attractive prices, whether you are doing it by selling calls on a covered call strategy, or selling puts shorting puts, okay, you can go out and capture vol on a very efficient basis.
Yep.
Versus your just rookie risk trader or rookie accumulator of Bitcoin. Yes, you're supposed to do that if you are in a chair where you have all the instruments to properly monitor and properly categorize your true risk exposure, okay? And this doesn't happen when you sit in your basement. This happens when you are working on a trading desk where you have lots of operational support, you have mathematicians, you have stop loss limits, you have a boss that'll come down to you and say, hey, dude, I mean, you're a pretty good kid, but you're a shitty risk manager. Get the fuck out of all your positions. I'm telling you. And that's what happens when you sit in a risk chair, when there's other guys who have sat in a risk chair for way longer than you have, rather than sitting in your basement saying, I'm going to be the world's greatest risk trader because I'm 25 years old and I learned this stuff in a textbook. No, it doesn't work that way.
Yep. Okay, so last one, and this is an important one, at least in my opinion, because we have to be honest and we have to be credible and in your opinion, what do you think the biggest I don't know, I guess you could call it blind spot is for the Bitcoin community in your view? Where do you think it's lacking in its view of the world or in its consideration of risk, right? So I guess that's how I'd ask that.
Gosh, okay, so I'm going to I've used this line once already, though. Look at the donut, not at the hole. I mean, there is a hole, and in that hole could be something like quantum computing, which I still don't believe is a true, risk. But in that hole could be the ability of global governments to shut down the internet, okay? Absolutely, and make it illegal. And yes, that's, again, it's not a zero probability, but again, it's part of a whole that I don't want to focus on. I want you to focus on the donut, okay? Again, it has to do with already the market's telling me with 99% certainty that my $2 million price target is outrageous, okay? What do I need it to go to 99%? No, fuck you guys. Okay, sorry, you can edit that out.
No, it's okay. No, it's Hedgeye. Go for it.
don't even think that I need something to go to 99.9%. You're already giving me 99% chance it's going to zero. You guys have not done the math, okay? And anyone who's trying to look at that other little thing, that 1% that's going to make it go to 100% certain, go and work for Peter Schiff. You're too fucking stupid to be listening to this podcast here. You've never managed risk, okay? Just stay out of the way of people that have done risk management professionally, like Keith and your company. Michael Saylor didn't agree with Keith's. That doesn't matter. It does not matter. Bitcoin does not give a rat's ass what other people think. It's all about managing risk. keep doing the math. If you own zero, I don't think you're very smart. That being said, there's a lot of stupid money in the world, and a lot of it starts in Canada. A lot of it starts with funds that will invest in Celsius before they own Bitcoin.
Brutal.
What a bunch of brutal asset managers, okay? You get what you deserve. You get destroyed. Too bad that they're managing money for pensioners of Quebecers, my home province, okay? Because they are not a good risk manager. But they've proven that over time and time again. Be a good risk manager. Do the math. We'll see where this ends up. Let's talk in 20 years. Is that fair, Rob?
They're very fair. And in the end, they're a lot like everyone else. I guess you could say they'll get the price they deserve. So anyway, Greg, this is awesome. Thank you for your time. You're always welcome here.
I wish I was wearing my Montreal Expos hat, okay? We got close. We were never the New York Yankees of baseball, but the Montreal Canadiens, on the other hand, still give you your Rangers and your New York Islanders a run for the money. But okay, guys, thanks for listening to me.
Greg?
Sorry I swore. I swear because I care. I swear because I care. There's too many fat old white guys out there that are giving people horrible advice.
Go for it.
And you know who's fat and old? Charlie Munger and Warren Buffett, okay? Quit lying to people. I know you guys are smarter than that. And George Noble, do some math as well. Love you guys. For the kids. Talk to you later, Rob.
Greg, be well, all right? Talk soon.
Thank you, my friend.
Thanks, everyone, for joining. Absolutely. Thanks, everyone, for joining us. And we'll definitely try to have Greg back. I mean, awesome listen, as you can tell. And until next time, thanks a lot.